Hello again, everyone. This is Ken Weber, president of Weber Asset Management. Today is January 16th, 2024, our first video of the new year. Happy New Year, if it's not too late. I'm joined, of course, by our chief investment strategist, Jack Bowers, out in Lake Tahoe. I'm here on Long Island. Hi, Jack. Happy New Year again.
Happy New Year.
And to all our clients. Let's get right into it, some of the topics that clients have been asking about. And I'm going to start with the Federal Reserve. The Fed has been aggressively raising interest rates for the last several years. Things have stabilized. And so, Jack, our first topic for today that I'm throwing in your lap is, what is your outlook on the Fed's outlook for interest rates near term and perhaps mid and long term?
Well, the communication out of the recent meetings is that we're pretty much done with the tightening cycle at this point, and the market's focus has more or less shifted to how fast interest rates will be cut. The Fed's own dot plot showed that there might be 3 interest rate cuts during 24.
Excuse me, did you say dot plot?
Yeah, they do this anonymous thing where each Fed member puts their expectations down, and then they put it all on a scattergram, and you can see kind of what the overall consensus of the Fed members is. And
I admit, I'd never heard of that, but
no, okay,
it makes sense. It makes perfect sense. Yeah. I got it.
Well, the dot plot shifted quite a bit in the last meeting, and because it showed that, unlike the previous dot plot, which showed like potential for additional increases, this one showed that most Fed members had their eyes on rate cuts, and presumably because it's anonymous, the Fed members can more or less not worry about what people think, because they're not putting their personal opinions down, they're just putting their expectations down. So the market immediately priced in rate cuts. It actually had priced them in a little bit before the dot plot came out, but after it did, it all but cinched the idea that the Fed is done tightening at this point, and now the focus is on how fast the rates will come down. My concern, of course, is that the rates may not come down very fast, and the economy may still weaken further before we see some relief. And I think that's starting to become evident in the earnings outlooks that we're starting to get. And what it could mean is that 2024's market is a little bit like 2023, where the economically sensitive stocks kind of languish, and the companies that can provide growth continue to edge up.
So let me just be clear that your outlook, and it's mine as well, is that there are still some people who think the Fed might continue to raise some rates for various reasons. You're saying you think interest rates have stabilized, and if any movement is going to happen, we're going to see them come down.
Yes, I think the tightening cycle is over.
Tightening meaning raising.
There's an outside chance the Fed might come along with another quarter point hike, but it just seems pretty unlikely at this point.
The consensus clearly is that there will not be any further interest rate hikes from the Fed. I just wanted, for the record, there are some people who say, because this segment of the economy is doing very well, they might boost rates a little bit. Jack agrees, and I agree that with the consensus out there, that rates will not go up, which is not only good for the stock market, but Jack, it's certainly good for the housing market, which has been hurt because of high mortgage rates, for example.
Yeah, you have some commercial property markets in a pretty deep slump as a result of employees working a higher percentage of their hours at home, and you have rents that have stopped climbing as well. So the real estate is very diverse. There's like areas of growth and areas that are in deep trouble, but in aggregate, it is definitely slow and slowing at this point in time. And if the Fed moves cautiously in bringing rates down, we could see property prices in a deeper slump before we see improvement.
It's important for our viewers to know the economy is not a monolith. You will always have its pistons going up and down, no matter who's in the White House, no matter what's happening with the Fed interest rates. Some segments chug along nicely while others slump, and then it changes. So right now we have many parts of the economy booming along. Headline in the Wall Street Journal yesterday was the main headline was strong economy. That was the first two words, and talked about what that meant. But it's a strong economy overall, but certain segments are languishing, real estate being a prime one because of the higher costs of mortgages. What you're saying is, as that starts to come down a bit, that should loosen the grip that the high rates have on the real estate market.
Possibly, in general, whenever you have rates coming down, it makes it easier for small businesses to expand and invest. And that's a necessary thing now with wages being a lot higher than before the pandemic, and with it being harder to hire people to do things.
Right. And the unemployment rate is quite low. I expect that's going to move up a little bit as the economy stabilizes. Jack, I want to talk about a couple of things that clients have asked me to ask you. Let's talk about technology.
Okay.
Tech stocks have swung wildly over the last 5 years. Just talk about the last several months and what you foresee for the next several months.
Sure. I think last year's technology rally was very narrow, with the Magnificent Seven being so dominant, and a little concerning just because the prices got so high with that group of stocks.
Not everybody is up to speed on the Magnificent Seven. Before it used to be the FANG, FAANG, Facebook, Amazon, Apple. Now it's the Magnificent Seven, which is NVIDIA, which is the new one to that group. Apple, what else is in there?
Microsoft.
Tesla's in there, Microsoft, right?
Google, or
all tech companies, big technology companies.
Yeah, they now account for about 30% of the S&P 500, right. And a very dominant position. We're only now seeing the tech rally kind of broadening out a little bit to some of the other chip makers as AI demand starts to work its way through the system.
Right.
But it's clear tech is kind of a major pillar of the economy at this point in time. And the trick, I think, right now is how do you gain exposure to technology without having portfolios that become too risky or paying up too highly for prices in stocks. And there are some ways to do that. We're working on it. I allowed the portfolios to become a little bit underweighted on tech late last year, just because I was concerned there may be a fairly strong pullback. But we've had that pullback. It wasn't that bad. And now we're seeing in the earnings reports that really the underlying demand for technology and technology company earnings are still holding up. And so I think we'll be looking for ways that we can get our tech weighting in our portfolios back up to a market level.
Clients, and I can understand, become upset with us if we don't have the tech weighting exactly right. Since, as Jack said, the Magnificent Seven, or whatever the number is, they account for like 30 or 40% of the movement of the market.
30% of the S&P, yeah.
Yeah, and it's crazy. So it's not a broad-based rally. But you can't time it. This is the perfect time to be in technology, and this is a bad time to be in technology. Our job as financial advisors for our clients is to balance risk reward. We're doing that all the time. Jack is a technology guy at heart. And so our inclination is to be overweight to technology, but we always have to balance what's best for the next 6 months, since it's always a black hole. Nobody knows for sure what's going to happen.
Yeah, it's really having the right kind of technology exposure. And at this stage in the game, I think it's, having technology exposure without paying too much for it. That's really the challenge.
Right. Okay. Other clients have asked us about the supply chain. Now we have the problems in the Middle East, certainly with the Israel-Hamas war going on, but specifically the Gulf of Aden, the Red Sea, and the shipping costs have skyrocketed for some small number of ships that now have to go around Africa. And that will, A, raise their rates, and B, certainly slow down. It'll be a kink in the supply chain. which has a bad connotation because during COVID, that was a very big problem. And I know, Jack, you see things a little bit more sanguine than many people.
Yeah, it's kind of, as I see it, a one-time inventory building exercise, because with the cargo ships needing to go around the southern tip of Africa, it's adding 10 days to 2 weeks to the journey, and it's boosting shipping costs. And so we have this kind of one-time adjustment for the additional time that it takes for parts to reach factories and other things that are en route from Asia to Europe. So, you know, we're paying for that right now. Some automakers have announced that they're going to, you know, shut down production briefly to accommodate the delay in part shipments. I'm sure there's other things we'll hear about as well. And once that is absorbed, I think the system can more or less operate normally with a little bit higher shipping costs until the situation is resolved. So I don't think it's a major red flag economically for the global economy, but it's definitely going to have its impact.
It'll have its impact. Hopefully, the aggressive action the U.S. military is taking against the Houthis, who are causing the problem. Hopefully, that will put a lid on the problem. If, God forbid, it becomes a much bigger war, mini war, whatever name we want to give it over there, that could happen. We hope it doesn't. We're not predicting it happens, but that's the problem when you're in investing. When you're in the world of investing, there's always 10 scenarios I could write about why the market is going to plunge or could plunge. But, you know, those are all the what ifs that we have to deal with.
One interesting thing, though, is with the U.S. shale producers having ramped up substantially since the pandemic period, U.S. output of shale is running at record levels. When this all came about, everybody thought it would cause the price of oil to jump, but instead the price of oil went down. So I guess the good news is you can see with a more diverse supply system for oil brought about by the shale industry in Canada and the U.S. It's a different dynamic now. The U.S. is self-sufficient on energy,
right.
A major supplier for Europe now, and so situations in the past that might have created a economic drag are less inclined to do so today.
Yeah. For our viewers at home who see the sunlight coming onto Jack, that's not your screen. That's actually it's slightly. There you go, Jack. I don't want our viewers to be distracted by that in your eyes.
Blinds that block most of the sunlight.
Okay.
Through.
we do these videos at different times of the day, and you never know what's going to happen. All right. So now we get down to the nitty gritty that we always touch on. Jack, let's talk about outlook for the stock market over the next several months. What do we see?
Boy, it's a tough one to predict at this point. I think it's going to be very earnings focused, as it has been over the last several quarters. We had this kind of contraction in earnings that has more or less run its course in 2023. It was widely expected, and now the forecasts are for earnings to pick up through 2024 progressively through the quarters, and the market will move on how the analysts revise those expectations. If they revise them upward, we can see rallies. If they revise them downward, we may see contractions. But it is really kind of an earnings game. I think we've seen rising productivity to the extent that is continuing this year. It will help boost earnings, perhaps exceeding analysts' expectations.
Right. And consumers, by the way, are spending.
Right.
Now, good news, bad news, they're spending a lot. They're going into debt a lot.
Well,
yeah, I saw a story.
The thing that the pandemic did is it raised household net worth by 30%. That's an enormous number, even more than the amount of printed money went up, the household net worth went up, because consumer household net worth is mainly determined by real estate values and stock values, and both appreciated substantially since the pandemic.
Right.
So households are sitting on a nice boost in assets, and they can afford to outspend their income. What we're really seeing is the wealth effect kicking in. They say that real estate wise, if prices of people's houses go up, they can spend up to 5% more, 5% of that increased value every year, just, because of the situation they have. And it even happens with stocks as well. The wealth effect's closer to 2 or 3% there, but consumers can, rightfully rack up some debt knowing that they've got some assets to balance it. And I think we're definitely seeing that. And if you run some of the numbers, you can see that consumers have the wherewithal to be spending, like they are now for.
And they were, right.
Yeah.
So the holiday season was a good season.
Right. And wages are up too. I think people don't really, even for households that don't have much real estate or stock market wealth, those benefited most from the wage increases. A lot of working class wages are up 25, 30, 35%. And as a result, those households also have the ability to spend more simply because they've got a higher wage base. So I think consumer spending is unlikely to weaken. It's probably going to be the strongest pillar throughout any economic slowdown that we see. So that's one of the reasons that we've got consumer discretionary as the most heavily overweighted position in our sector model.
Right, which I totally understand. And we always have to talk about, if you think it's difficult to predict the stock market, it's even more difficult to predict the bond market. But we have clients certainly in bonds and bond funds. And so let's take a stab at it, Jack. The fixed income market.
Yeah, it's very hard to predict at this point. I kind of hardened the bond side of the portfolios against interest rate increases, so that if we did see additional upward pressures, we wouldn't really have any negative effect on the returns. So we're very much emphasizing short maturities and high income streams at this stage in the game. And I guess an argument could be made now that the Fed is, more or less done tightening, that we could be moving back to normal, so to speak, in bonds, taking on some interest rate risk. But I want to move cautiously on that front. There's a possibility that the yield curve will go back to normal by having long-term rates come up as opposed to having short-term rates come down, or maybe a combination of the two. And so it still could make sense to be in this kind of defensive bond position a little longer. There's not, if you look at bonds as mainly being a way to keep risk down and generate an income stream, what we have is doing that. It's just a question of how well we'll perform against the bond index.
Yeah, most of our clients know that we use bond funds to reduce volatility, to reduce the risk level. Jack was a little loath to make a prediction. I'm going to predict that I think it's going to be a good quarter for the bonds that we have in our client portfolio. I'll see you in 3 months and we'll decide how I did. But based on what I'm hearing from the Fed, I think the bond funds are going to do pretty well this quarter, and probably the next. Time will tell. Time will tell. Nothing is guaranteed in our world. Right?
That's correct. Yeah, you're just kind of responding to the signals with bonds at this point in time. It's pretty clear you can outperform inflation with the income streams at this stage in the game. So if we can do that and cut risk in our portfolios, we're largely satisfying our goals there.
I meant to bring that up. I almost forgot. Inflation is pretty much under control. It's down to around 3% annualized. The target had been 2%. I've been reading lately that 2% is really an arbitrary number. There's no real science behind 2%. Somebody came up with that as a target years ago, and they picked it. So whether it's 2% or 3%, it's certainly a lot less than the 9% we were seeing a year or 2 or 3 ago. And it's important for everybody to realize the American inflation rate is still amongst the lowest in the entire developed world. So again, another reason why money is staying in America in terms of stocks and bonds. The world still looks to us for leadership in the the financial markets.
Yeah, there's a lot riding on this productivity boom we're seeing, or mini boom, whatever you want to call it. I think with AI technology, there's a chance that it could be extended for a long period of time. And if that's the case, we may see a period like the late 1990s when US productivity was just substantially higher than the rest of the world, and employers could absorb wage inflation easily and without passing on costs. It was just kind of an ideal economic period for growth. So there are signs that we're returning to that. The big unknown is how much AI technology is going to boost real world productivity, and that we may not even know the answer for several years. But so far, the early signs are really good.
I agree. I use AI just for fun, but man, there's stuff coming down the road we can't even imagine yet.
Yeah, that's for sure.
So one day you'll be talking not to Jack and Ken, but to our AI overlords. Hopefully that's
hopefully not. Yeah,
not in the near future. Not in the near future, Jack. Jack, we've run out of time. We've used up our allotted time here. I want to thank you all again. Thanks, Jack, and thank you all for participating and watching. And we'll see you next time. Thank you all. Bye-bye.